Let's review chapters 16 and 17. So, our first question here deals with debt investments. We're given 5 different transactions and we need to prepare all these journal entries. So, let's work on this first transaction here. We are purchasing 35 $1,000 Taylor Corporation 5% bonds for $35,000. Interest is payable annually on January 1st. So right now we need to record the entry for the purchase of these bonds, the purchase of the debt investments. So before we talk about that journal entry, let's break down what that first sentence is even saying. So we're buying 35 bonds. Each bond has a face value of $1,000, and there's a 5% interest rate on these bonds, and we paid a total of $35,000. So whenever we record debt investments, the purchase of bonds, we're always going to record it at cost. So your journal entry here is going to include a debit to debt investments to show that we have more debt investments, and a credit to cash for the cost of $35,000. So that's the framework of your journal entry whenever you are purchasing debt investments. Then at the end of the year, we need to accrue the interest. So we aren't receiving the interest yet, right? Because we were told that that was going to be payable on January 1st. But we need to count the revenue in the year that it happened. So our journal entry here is a debit to interest receivable and a credit to interest revenue. To find the amount, we need to use our interest formula. So principal times rate times time. Our principal was that $35,000. Our rate is the 5% interest rate times 1 because it's been 1 full year that we've had these bonds. So we multiply all of that out and we get this 1,750. So we toss that into our journal entry. Now the following day, we are receiving this interest. So we put it into interest receivable back here on December 31st. We are now going to take it out of interest receivable and show that we are getting the money here on January 1st of 2019. So we debit cash and credit interest receivable for that 1,750 that we had just calculated on the last slide. Also, on January 1st, we sold 15 of these bonds. So we initially purchased 35. A year in, we decided that we want to sell 15 of them. And we're selling 15 of them for a total of $18,500. So a few different pieces that we're going to start off with here. We are receiving cash. Since we are selling these bonds for a certain amount of money, we need to show that our cash is going up. So we debit our cash in this journal entry. And what are we selling? We're selling our debt investments. So we are crediting debt investments also. And then you'll notice that there's a gap in between. There's going to be another account that will pop up here that we're going to talk about in a bit. Your cash, that's just your $18,500. That's the amount of cash that you received. Debt investments, like we said, those are always going to be recorded at cost. So we need to figure out these 15 bonds that we're selling. What was our initial cost of 15 bonds? Well, we paid $1,000 per bond. We're selling 15 of them. So those would be worth $15,000 if we are recording it at cost, right? So we will credit our debt investments for that $15,000. Now you'll notice your debits and credits don't equal, and that's not okay with journal entries, right? We need our debits and credits to equal. Well, we have this extra $3,500 over here that we need to add to the credit side. What this is going to represent is a gain or a loss on the sale of these debt investments. So we had debt investments that were worth to us on our books of $15,000. we were able to get people to pay us $18,500, which means we have this gain on the sale of debt investments, since we received more cash than what the debt investments were worth on our books. If it was flipped, if we received less cash than what our debt investments were worth, that would be a loss on the sale of debt investments, and that would end up being a debit in this journal entry. Now we need to accrue the interest on these bonds in 2019. So the framework, exactly the same. Debit to interest receivable, credit to interest revenue. The number is where things are going to change up a bit. Because if we take a look at our interest formula, it's principal times rate times time. Your interest rate's still 5%, and your time is still going to be the 1 full year, but the principal's not going to be the same, because we sold some bonds at the start of this year. So our new principal amount, when we subtract out that $15,000 that we had credited debt investments for in that last journal entry, our new principal is $20,000. So we toss that into our interest formula, 20,000 times 0.05 times 1, and we see that our interest for 2019 is $1,000. Now, question number 2 says, NOSCAR Inc. had the following transactions pertaining to investments in common stock. So these are stock investments, right? We dealt with debt investments in question number 1. Question number 2 dives into stock investments. So we are purchasing 2,500 shares of Escalante Corporation common stock for $152,000 in cash. And you'll notice that little 5% there. When we're dealing with bonds, if we're given a percentage like that, we need to be thinking interest. But stock doesn't come with interest, right? That 5% represents our percentage of ownership in Escalante Corporation. So we own 5% of their stock, of their business. So that's going to tell us which method we need to use here for our journal entries. So January 1st, we purchased those shares. December 1st, we sell 500 of those shares for $32,000. So let's take a look at these journal entries here. Since we only own 5%, we're somewhere between 0 and 20, which tells us that we need to be using the cost method. So on January 1st, to show that we purchased 2,500 shares, we debit stock investments to make that account go up, and we credit cash. And we just toss in the cost of this investment. So our stock investments are increasing by the $152,000. Our cash is decreasing by the $152,000. Now on December 1st, we sold 500 shares of Escalante Corporation common stock for $32,000 in cash. So we initially purchased 2,500 shares. A few months go by and we decide that we want to sell 500 of those. So let's start working through our journal entry here. We know that we are going to be receiving cash. It tells us right there in the transaction, we sold it for $32,000 in cash. So our cash has to be debited to show that that is increasing. Stock investments has to be credited. Now, the problem doesn't come out and tell us how much stock investments should be credited for. Once again, you'll notice that there's a gap in between cash and stock investments in this journal entry. They're not going to be for the same amount. Stock investments are going to be recorded at cost. So we need to figure out these 500 shares that we're selling here in December. What were the cost of those 500 shares? So we will put in that debit of $32,000 for cash, But for stock investments, we need to calculate, right? So we purchased 2,500 shares for $152,000. That'll be $60.80 per share. So we took the 152 and divided it by the 2,500. When you do that, you'll see that each of those shares we paid $60.80 for. Here on December 1st, we're selling 500 of those shares. So we take 500 times that per share cost of $60.80, and we get this $30,400. So, once again, your debits and credits don't equal. We now have this gain on the sale of our stock investments of $1,600, the difference between the cash and the stock investments. And once again, it's a gain because we got more cash. We received $32,000 when our stock investments on our books were only worth $30,400. So since we received more cash than what we had as the cost of these 500 shares, that's what tells us that it's going to be a gain. If we had received $25,000, right, anything less than the $30,400, then we would have had a loss on the sale of our stock investments. And again, losses would go over on the debit side. Now, question number 3. We need to prepare the journal entries for Knoller Company for the following transactions. So, Knoller Company acquires 25% of the common stock of Lauer Company for $150,000 on January 1st, 2019. So you see there that we are now purchasing 25% of another company. We're no longer in the cost method world. We're now between 20 and 50%, which tells us that we're going to need to be using the equity method. And then at the end of 2019, Lauer Company reports a net income of $180,000 and declares and pays a $50,000 cash dividend. So like we said, we're between 20 and 50%, so we're going to be using the equity method here. So on January 1st, we are acquiring stock in another company. Here's what's nice about cost method and equity method. Either way, the entry is going to look the same. It's a debit to stock investments and a credit to cash for the cost of that investment. So we debit our stock investments $150,000 and we credit our cash for $150,000. Now here's where things change up a bit here. At the end of 2019, Lauer Company reports a net income of $180,000. If we owned less than 20% of the business, it doesn't matter what the company reports as their net income. If we were using the cost method, we don't receive any piece of that. However, when you own between 20 and 50% of a business, you do receive part of that net income. So, here's what's going to happen here at the end of 2019. We're going to be debiting our stock investments and crediting our revenue from our stock investments. So, when there's net income, that will increase a company's retained earnings. If retained earnings are going up, your stock investments will increase as well. Now, we don't receive all $180,000. That was their total net income. We own 25% of that business. So we take $180,000 times 25%, and we get $45,000. So we toss the $45,000 in there for our journal entry. Now, declaring and paying a cash dividend. If we were using the cost method, we would show this as a debit to cash and a credit to dividend revenue. It's slightly different under the equity method. Under the equity method, it'll still be a debit to cash because we will still be receiving cash, but we're going to be crediting stock investments. And this is where that comment that I made a little while ago about when retained earnings changes, so does your stock investments. Well, net income increased retained earnings, so we increased our stock investments when we reported the net income. Dividends decrease your retained earnings, so we're going to decrease our stock investments here in this last journal entry. And once again, the $50,000 that we're told, that's the total cash dividend. We aren't going to be getting all of that. We only get 25% of it. So 25% of 50,000 gets us this 12,500. Now question number 4 says Rojas Corporation's comparative balance sheets are given. We need to prepare a statement of cash flows using the indirect method. So we have our comparative balance sheets here, and we can see that cash obviously changed, accounts receivable, there was a change, land, there was a change, right? So we can go year to year and figure out how accounts increased and decreased. And then we have some additional information down at the bottom. It says net income was $22,630. Dividends declared and paid were $19,500. There were no non-cash investing and financing activities. And the land was sold for cash of $4,900. So we're going to use all of this information here to prepare the statement of cash flows. Before we actually start on the statement itself, though, it's going to be best to go through and see how things changed. Right? So cash increased from 2016 to 2017, right? This entire statement is going to explain that increase. So that won't be an individual line item like some of these other pieces will be. So we're going to start by looking at our accounts receivable. And we see that from 2016 to 2017, accounts receivable decreased by $2,200. Right? It went from $23,400 down to $21,200. So we'll make note of that. Land decreased by $6,000, went from $26,000 down to $20,000. Buildings did not change. Accumulated depreciation on those buildings, though, did. So that $5,000 difference there is going to be our depreciation expense. And depreciation expense is one of those non-cash expenses. So we'll see where that goes on the statement of cash flows in a bit. Then we move down to accounts payable, and we see accounts payable decreased by almost $19,000. Right, so we'll make note of that. Common stock increased by $6,000. So we'll make note of that as well. Retained earnings, you'll see, went up, right? It went from $20,000 up to $23,130. Again, we don't need to make note of that at all, because if we look under additional information, net income and paying out dividends were the reasons why that retained earnings changed. So we will note our net income and our dividends paid. Those are two pieces that will go on our statement of cash flows. No non-cash investing or financing activities. That's nice to know. That means that any kind of changes in land, like we saw this decrease in land, must have been for cash. Any increase in common stock, like we saw there, must have been for cash. So if we're told that there's no non-cash investing and financing activities, that just helps explain that all of these other changes dealt with cash. Now our last piece here, the land was sold for $4,900. So we look up above at our land and we saw that it decreased by $6,000. that decrease must have been this sale of land that we had. So we received $4,900 from that sale. So we're going to call that the proceeds from the sale. But you'll notice that those two numbers don't match up, right? We sold land that was worth $6,000, but only received $4,900, which means that we had a loss on the sale of $1,100. So now we have all of these pieces. We need to decide whether they are operating, investing, or financing activities. So accounts receivable is a current asset. Any changes in current assets falls under the operating activities section. Depreciation expense is a non-cash expense. Any non-cash expenses like depreciation or amortization, those are also operating activities. Accounts payable is a current liability. Any changes in current liabilities will be operating activities. Then we get to the increase in common stock. Well, if common stock increased, that means that we issued more common stock. And whenever you issue common stock, that's a financing activity. Net income, that goes at the very top of our operating activity section. Paying out dividends, that will be a financing activity because we are paying those to our stockholders. Proceeds from the sale of land. So whenever you purchase or sell property, plant, and equipment, those will be investing activities. So investing activities are long-term investments or buildings, land, and equipment, buying or selling. Then we have this loss on the sale of land. Any kind of gains or losses that you have, those will be operating activities. Now that we have all of this, we can create our statement of cash flows. So we start off with our cash flows from operating activities. And our first piece is going to be this net income. So our net income is $22,630. Now that's our accrual basis net income. What we're trying to do here in the operating activity section is turn that from accrual basis to cash basis. So we then have these adjustments to reconcile our net income to net cash provided by operating activities. And this is where all of those other activities in the upper left that have operating next to them are going to come into play. So we have this decrease in accounts receivable, $2,200. We need to think, what does this do to our cash? Well, if accounts receivable is decreasing, that means that people are paying you back. So we are receiving money, so we add that. It's a cash inflow. We are getting this $2,200. Depreciation expense. Depreciation expense is a non-cash expense, which means that when you calculated that net income of $22,000 originally, you would have subtracted out that depreciation expense along with all of your other expenses. But you never actually had to pay anyone because your building depreciated. So non-cash expenses are added back in on a statement of cash flows. Our next piece is a decrease in accounts payable. Accounts payable is a current liability. And if your accounts payable is decreasing, what's happening is you are paying people back, right? Accounts payable is when you owe people money. So if you made that account go down, that means that you paid people. So that's a cash outflow. So before we continue on, I want you to notice here some patterns with our current assets and our current liabilities. Changes in current assets, like accounts receivable, we will be doing the opposite of whatever the change is. So a decrease in a current asset would be added. An increase in a current asset is going to be subtracted. When we take a look at current liabilities, like we have here with accounts payable, the change and the add or subtraction on our statement of cash flows is going to be the same. So a decrease in a current asset is subtracted on a statement of cash flow. An increase in a current asset or a current liability, is added. So a decrease in accounts payable, subtracted. An increase in accounts payable would be added to the statement of cash flows. Now we have one last piece here for our operating activity section. It was this loss on the sale of land. Losses are going to be added back in because once again, that would have been taken away from your net income when you initially calculated that. If we were to have a gain on the sale of land, that would be subtracted. So now that we have all of these, we'll add up those four and we get this negative $10,430. With that, we can now find our net cash provided by operating activities. To do that, we take the $22,630, we take our net income, and we subtract that $10,000, and we get $12,200. Now, if that $12,200 was a negative number, we would call that net cash used by operating activities. But since it's positive, we call it net cash provided by operating activities. So then our next section is our investing activities portion. And we had one single piece in our investing activities, the sale of land. So if we were to sell land for $4,900, that means that we are receiving the money. So it's a positive $4,900 on this statement. Then we can find our cash flows from our financing activities. We have two of these. We have the issuance of common stock first. So if you issue common stock for cash, you are going to be receiving the money. So that's a positive $6,000. Our next piece is the payment of dividends. So if you pay dividends, that means that you are paying money to your shareholders. So that's a negative amount. That's a cash outflow. So we subtract that on our statement of cash flows. So with those two, we can find our net cash used by financing activities, which is a negative $13,500. So since that $13,500 is a negative number, that's why we see the net cash used by financing activities rather than net cash provided. Once we have those, we can then find the net increase or decrease in cash. In this case, it's a net increase of $3,600. The way that we find that number is that we take the net cash provided or used by each type of activity. So operating activities was $12,200. Investing activities was just that $4,900. Financing activities was that negative $13,500. You add those together and you get the net increase in cash of $3,600. We then show the cash that we had at the beginning of the period. We add those together and that will give us our cash at the end of the period, the $14,300. Now that we have this, we can calculate our free cash flow. So our free cash flow is net cash provided by operating activities minus capital expenditures minus cash dividends. So net cash provided by operating activities, that's our $12,200, right? That's given to us. Capital expenditures are any time that you purchase property, plant, and equipment. We didn't have any of those, right? We sold land, but we did not buy any property, plant, or equipment. So we don't have any capital expenditures in this problem. Cash dividends, we did have some at $19,500. So we take our $12,200 minus 0 for no capital expenditures, minus $19,500, and we get a free cash flow of negative $7,300.